Oh, who's on my Hangout already? Hold on, guys. Hold on, guys. Okay, now I need to go to this. Oh, who's on out already? Hold on, guys. Hold on, guys. Okay, now I need to go to this. Oh, who's on out already? Hold on, guys. Hold on, guys. Okay, now oh, who's on out already? Hold on, guys. Hold on, guys. Who's already? Hold on, guys. Hold on, guys. Oh yeah, don't need this. There we go. Okay. Now I gotta call Eric. Just hold on, folks. Just gonna be a second here to get Eric on the line. And we'll get started. I got everything set up. I got to get Eric on the line.
Hello.
Eric Coffin.
How's it going, buddy?
It's going good. We're semi-started already. I've got you live here, so I just got a link out to the chat site. Oh, for some reason it's not. Oh, I got to publish it. If I publish the website that our thing's live on, they might be able to watch it.
Okay.
So I'm just doing that now. How's your day so far?
It's been all right.
Yeah. Okay. Here. All right. I'm just gonna paste this in the link, and we'll get started in a second here, Eric. I think it's all working good for me. Copy. Okay. All right, Eric. Well, I pasted it in our favorite chat site there, so let's get rolling. I'll start here. I'm Allan Laboucan. I'm the editor, founder of the Allan Reports. And I've got a very special guest today, Eric Coffin from HRA, Hard Rock Advisors, has joined us. He's kind enough to have joined us on the phone. How are you doing today, Eric?
I'm doing pretty good, Alan. How about you?
Excellent. And I see our audio is going through good, so we're in good shape. Before we get going, Eric, I wanted to let you know about some news on the Allan Reports front. I just got a new sponsor there, Premier Gold Mines. PG on the Toronto Exchange has joined me as a website sponsor. Are you following them?
Only very irregularly. I'm a fan of Ewan's, however, so Ewan usually finds a way to make things work. I don't doubt that he'll find a way with Premier, like he has with most other things he's touched.
Yeah, well, they've got a pretty good, it's as I'm bullish on gold, and you know, the as far as gold companies go, I think Premier is one of the best if you look up the chain a little bit, but they offer both exploration and development. So I think they've got a very compelling growth story ahead of them there.
Yeah, no, it's a good company, and it's well structured, which is something that can't be said for most these days. Compared to a lot of its peer group, there's not a lot of cheap paper floating around or anything.
Yeah, exactly. Well, I'm always encouraging folks to do their homework on my sponsors. My other sponsor is Wolfden. You and I have Wolfden Resources, WLF, on the Venture Exchange. You and I have talked about that one a bit. Any insights there for my audience, Eric?
I'm just waiting to see some of these holes that I don't. Do you know whether they're drilling yet? I know they were close the last time I talked to them. They were just waiting for the ice to get about an inch thicker. I'd like to see some of these extension holes. I mean, they've got a nice resource, but I think it needs to be bigger to be something producible. So I'm waiting to see. I'm very interested in whether they get some holes into some of these outside targets. It look pretty interesting. Yeah,
well, that's the ice question, and yeah, they last time I saw Don Hoy was at the resource conference there, and he said he was on his way back home within the next day because he was getting ready to get drilling. So I'd imagine if they're not drilling now, they will be drilling within days.
Okay.
So yeah, then they can chase those targets. All right, Eric. Well, next up, I think we'll get on with the show. Thanks for some insights there on my website sponsors. They make my work possible. So I like to have my guests give me an opinion on them. I think what we'll do, Eric, is I'm going to be using some screen shares while you're speaking because you're on the phone.
Okay.
And I'll get that working here. The first one I guess I should start with is why don't I go to your website first, Eric?
Sure.
And tell us a little. Why don't you start off by telling us about the Hard Rock, your company. I've been following you for a long time. I've listened to your stuff, and we tend to kind of go towards the same kind of companies. I think we look for similar stuff. We try to follow what the Truth Machine is saying, and I think that's why we've kind of bumped elbows in the past with picks. But why don't you let my audience know a little bit about what you do there at your website?
Hard Rock Analyst is 20 years old now. My late brother David and I started it in '95. It started out as a monthly publication. It's now very loosely a bi-monthly publication, although there are times like the last issue where I'll intentionally let things pile up because I've got a bunch of editorial content I want to cover. In addition to that, there's an alert service, which is just, essentially it's as needed. You might go a month without seeing an alert, and then you might see 3 of them in 2 days.
Well, is that basically because obviously you're looking for certain things to happen, right, Eric? You can't just sort of make that up.
It hasn't exactly been an active market lately, so there hasn't been a lot to, a lot of the recent ones were market updates as opposed to company updates, because as we both know, the companies in general haven't been that active lately. But as you said, I mean, I have a fondness for exploration stories, although I do have a number of development level companies that are, a couple of which are on their way to production now. I don't generally cover the really large companies except tangentially when one of them takes over a company that I talk about. I mean, I don't think the world needs another analysis of Goldcorp or Bear. There's hundreds of them out there already.
I've got your website up there now, and it's scrolling through your pictures. I see the Yellen comes down the chimney. That was another thing I wanted to talk to you about, Eric, is that I was recently at one of your conference, your subscriber conference, or no, it was the Metals Investor Forum.
Yeah.
And I got to say, I really enjoy the conferences, that particular format where we get to sit down and listen to a few presentations just after a speaker comes on. And I was there for yours as well as Brent's talk, and then the companies that followed. In fact, I was so impressed by it, I even wrote a piece about it recently, or did an article on it, on the companies I saw there.
Thank you.
Yeah, so that was recently, and I think we've got a lot to talk about regarding that. But let's not forget your upcoming one before we later in the show, John, or I mean Eric, because we want to let people that are in Toronto for the PDAC know that they can come to your subscribers conference and get a lot of great info.
Yeah, it's the same format. The Subscriber Investment Summit is on March 5th, the day before PDAC starts in Toronto. It's at the Hilton downtown. Really good venue for this type of conference. I co-host this with Keith Schaefer and Tommy Humphreys. We've got a really good lineup of companies already. If you want to get more information, then probably the easiest way to do it is just type in subscribersummit.com. That'll give you a list of the companies, and there's also a link there that you can RSVP. And these do tend to sell out. We do tend to close the RSVP list ahead of the conference, so you might want to do that sooner rather than later if you want to go.
And that address, that's subscribersummit.com, correct?
Yeah.
Okay.
Yes.
I actually think I got it. Yes, I do. I have it up on the screen there. So I don't know if they can see the address, but Subscriber Summit, if it looks like what's on the screen, you've arrived there. And make sure and get into that, because it's a very comfortable way to hear a bunch of good stories. And what I really enjoy about that particular format you have, Eric, is that it's a curated list. You and the other speakers, you pick the companies that get to attend that, right?
Yeah, the companies, in order to be presenting at the Subscriber Summit, the company has to be invited by me or by Tommy or by Keith. Every time we do one of these, we get and it's an increasingly larger number of companies that get a hold of us and say, we want a booth. What does it cost? And the response always has to be, sorry, but we've got to invite you. This isn't a show where you get to just show up. One of the newsletter editors has to be following you. That's one of the criteria, and they have to invite you.
And all of those newsletter writers and people are very involved and experienced in the industry. So it's I really admire that part about the conference. What I noticed, Eric, is that sometimes when I'm hearing pitches at other conferences, they kind of get a little glazed over because I've heard it before. I've heard this pitch before, but because they were all good companies, they all had compelling stories. I was right into it, writing notes the whole time through. That's why I did the show on it later too.
Well, we get a bit of grumbling sometimes from presenters, but one thing that the three of us are all very firm on too is the time aspect. The simple truth is, you can't tell everybody everything there is to know about your company in 10 minutes, but you can tell them enough to know whether they're going to be interested or not. So we're pretty forceful about making presenters stick to that 10 minutes so that we don't have people falling out of their seats. And we do have very intentionally large breaks in between the segments where you can go out and talk to the companies. That they'll all have booths set up, and the Hilton's particularly good for this because the lobby area outside of the room that we use is actually quite large. So there's tons of space to move around and get your coffee and ask some questions. Plus, everybody that attends, as you know from Metals Investor Forum, Subscriber Summit's the same. Everyone who attends will get a stick with all of the presentations on it, plus additional material if the companies want to give it to us to add to the stick. So you can go back and look at it later. And I don't know, companies tell us that they get a lot of follow-up, more follow-up from these conferences than from others. And one thing that's particularly good about Subscriber Summit is because of Keith's input, hard rock guys like me get to listen to oil and gas stories that I wouldn't necessarily learn anything about otherwise. And similarly, Keith subscribers and a lot of his subscribers come to these, get to listen to hard rock stories and get exposed to new hard rock ideas that they might not necessarily listen to otherwise.
Well, and in other times in the past, Eric, myself, I usually stayed away from the oil and gas deals because they were a lot more pricey, and I want to speculate, and I don't want to speculate at $5 or $10 a share. But lately, with the pummeling in the price of oil, that they've gotten down to penny stock status. So I'm interested in good stories in the oil patch now because I can look at them.
Yeah, I've been bugging Keith for names myself. I mean, a year and a half ago, he was looking pretty smart compared to Tommy and I, truth be told. But the playing field's leveled out a bit in the last year.
He got some of our paid.
Yeah, exactly. Yeah, he was moaning about 6 months ago when Tommy and I were just rolling our eyes, going, "Yeah, welcome to my world, sunshine."
Yeah, wait, call us when it's been 4 years.
Mm-hmm.
Yeah. So Eric, let's get into some of the stuff that people actually see at your various different conferences. You recently wrote a couple articles on CEO.ca. I've got those loaded up here, so I can sort of scroll through them
Okay.
as you're talking. And why don't we give a plug to CEO.ca, considering you and I spend so much time on the chat site, and you write articles, and there's postings on there all the time. Tommy Humphreys has done a great job, with the chat and everything.
Yeah, I think it's far superior to anything else out there. I've always been impressed from day one when, I was never really much of a chat site guy, and Tommy bugged me to kind of come and hang out a bit. And I do often have it open as a window, and it's partially because there is actually good content there. There's a lot of very smart people. I mean, a bunch of them I know who they are, whatever their name might be on the site. I know who the real person is behind it.
Right.
There's some pretty smart people that hang out there and willingly, give their advice and trade ideas. And you get a lot of good ideas hanging out on that site, and it's interesting to see. The people that are chatting there react to news as it comes out, and I find there's a minimum of the kind of silliness that's so common on a lot of the other sites. I'm quite impressed.
Yeah, I think there's a healthy. I think there's a healthy amount of kidding around and joking. I think that's important too, because it can't just be a bunch of people pitching a stock and all just talk about stock and everything like that. I like to learn a little bit about the person, from who they are and stuff like that. And that's the one great thing that I really enjoy about it, the site and the chat, is when it does come to news, and the news is sort of unpacked in real time with a lot of sharp people. I think that's a great tool for investors. I think all investors should be signing up, and company people too.
I think I think you and I are in agreement that we've probably just seen a bottom, and that however long it takes to evolve, we're headed for a bull market again in resource stocks. And I suspect CEO chat is going to be a very, very, very busy place going forward.
Yeah, I'm really hopeful for Tommy. He's done a wonderful job there. He's built that thing all on his own dime, and I know what it's like. You know what it's like to be independent commentators and putting out content. It's not cheap, and he's done a great job there. So I always encourage my audience to get out there and spend some time on the chat.ceo.ca.
Absolutely.
Okay, so now we can move on to some of that exciting stuff. Eric, what do you want to get into first? Do you want to get into those articles that you wrote?
Sure.
Okay.
I mean, whatever you want. Those two articles are the first 2/3 of the editorial from the last issue. The third one will go up today or tomorrow, and it's even longer than the first two. It was a very, very, very long editorial.
Not a worry. Well,
just laying out what I thought would happen this year.
This show is perfect for that, Eric. We can unpack your thoughts here, and I've got it loaded up. I've got the first article that you issued on the 5th of February, HRA 2016 preview. So I'll scroll down so you know where I am in the presentation. You just tell me where to go. The first thing up is central banks terrified. Why don't we start there?
Yeah, I mean, I think as my readers know, I've been bearish for a few months now, and as my readers also know, I'm not by nature a bearish guy. I'm not one of these sort of gold bug uber bears the world's going to come.
Well, what I can say for sure is, Eric, whichever way you're going on something, you're clear, you've done your homework, and perma whatever, you're permanently always doing your homework, so you don't have to qualify it with me.
Well, I'm saying saying that largely because if people don't know me and they know that I'm liking gold right now, they automatically assume I'm going to be bearish. And I wasn't until a few months ago. I was fairly bullish about the equity markets, but I don't like the trends I've been seeing lately, where there's been a diminishing trend in overall earnings, not just in oil and gas, but in other sectors. This has been going on for a year now, and the market kept going up. There was growing divergences between a few headline names and everybody else, and the market kept going up. And when you see several central banks go to the point, the Fed being the one exception, go to the point where they're basically moving to zero interest rates or negative interest rates. In my opinion, again, I'm not one of these perma-bear guys who thinks it's some kind of a conspiracy theory. I don't see central bankers doing that unless they're seeing something that really, really bothers them. No central banker goes to negative rates unless there's stuff going on out there that's got them very nervous. And the fact they're that nervous, on top of the other divergences I'm seeing, has led me to assume we're going to see a bear market and probably a mild recession in the U.S. this year.
Yeah, my feeling on the overall market for a long time has been that it's overvalued based on long-term price to earnings ratios and stuff like that. It was on the stretched end, and the other part that concerned me was not only was the valuation stretched, but the earnings, as you said, were slow, and not only slow, but relative to where they are, the growth rate. You're paying a very high the market was paying a very high premium for that, modest earnings growth. And then you add in that you've got a lot of companies making their money internationally. Now they got to bring those earnings made somewhere else back into US dollars. The US dollar has been, causing problems with their earnings. And so I think we've got an earnings recession for sure. Whether the overall economy goes into recession, I still think that remains to be seen. But even calling for that, I think, is a pretty significant call right now, Eric.
Yeah, it may be that what we end up with is a couple of quarters of marginally negative growth, separated by some marginally positive growth. In other words, something that never gets called a recession officially, but I think it's going to feel like one.
Meandering right around growth and no growth, you mean, sort of?
Well, and part of the reason why I was getting so bearish was that, everybody and their dog was expecting the U.S. dollar index to go to 110, 120 back when it was 98, 99.
Not me.
I know you weren't. I did a bunch of interviews back in November and December, and was calling for a top in the U.S. dollar index, and pretty much everybody that interviewed me thought I was out of my mind. But my reason for that was simply, I basically said, look, is it possible that the dollar index would go to $1.10, given what other central banks are doing? Yes. Is it possible that we might see a new high in the S&P? Yes. Is it possible that we'll get both? No, because if the dollar index goes to $1.10 or $1.20, U.S. is going to have a recession. You can take that to the bank right now.
Got it. I see your rationale there. I get it. Yep. So, what do you think? I'm skeptical whether. I thought that I was even skeptical about one move by the central banks by the Fed. To be quite honest, sitting on $19 trillion in debt, how much can they really move? The market seemed to be ignoring that. When you look at the US dollar, it was looking like it was pricing in 2 points or something like that. What do you think? Where do you think they go from here, Eric? I really believe they're sort of painted in a corner that they can't get out of.
I think they are. I think the testimony we get tomorrow and the day after is the next 2 days is the sort of the biannual Humphrey Hawkins testimony, as it's called, which is Yellen getting grilled by Congress.
Yeah.
It'll be interesting to see how she reacts to things. I think Yellen wants to do another rate increase, not necessarily for what I would consider logical reasons, but because she's really trying to get across the idea that everything's normal, everybody relax. My sense is, having been overconfident for so long, I think the markets are spooked enough now that if she gets across the idea that she is actually going to try to raise rates again next month, I don't think the S&P is going to be very pretty this week, because I think that would freak traders right out.
So you don't think she's going to telegraph this next one?
I think she's going to imply that if everything is still as awesome as it is right now, that they could still pull the trigger. I mean, that was kind of what she was selling in December. Of course, it totally fell on deaf ears. Everybody thought she was nuts and sold the market down. I don't know whether she's going to try that shtick again. I kind of suspect she is. I don't think it's going to go over very well if she doesn't, though.
You know, I think that horse has left the barn a little bit, Eric, when it comes to her ability to sort. I think she's lost credibility with the market, and that's another.
I think the only thing traders want to hear right now is that she's not going to raise rates. That's all they want to hear. However she chooses to phrase it, they want to hear her backpedaling. I'm not entirely convinced she's going to backpedal. I mean, whether I think she should or not, I'm not convinced she's going to. It'll be interesting to see how she phrases things. She's really going to be walking a tightrope.
Eric, I just scrolled up, and now on the screen is the S&P chart in your report, just under the central bank stuff there. Let's go on to the S&P. I've been again. We talked about it earlier. Why we both sort of felt that it was overvalued and ready to roll over, and it has rollen over. You know, one of the indicators that I pay a lot of attention to is the January effect, and it has had the worst January in history. So that suggests, based on that analysis, that we're going to have a further difficult year this year with more lows. I went on record in early January calling for a 20 to 25% correction. I know that you are even more aggressive than that with a 25 to 30%. Do you think that we're in the process of that happening now, Eric?
I think so. I mean, I think the question is, do we get some sort of a real sort of cascade of selling, which isn't something I necessarily assumed would happen, or if it did, it was something that might happen later in the year. But I'm starting to wonder if we don't see that sooner rather than later. And I think the next month, you know, a combination of what Yellen says in the next couple of days, what the Fed does next month,
and how earnings come in.
And yeah, I mean, I don't have high expectations for earnings. I mean, you know, oil's got a bit of a bounce, but I suspect it sees a lower low before it bottoms, so I don't think that's going to help any. I think the odds are, if we get below that sort of October flash low that was like 1820 thereabouts on the S&P, you know, I think if we get below that, I would be very cautious, because I think that could open the floodgates. And the one other thing that could, you know, could bring us a bottom, I'm kind of assuming the bottom comes in the first half of the year, and the other thing that could drive that is, as we get towards the end of this quarter, you know, going into the end of last year, the S&P was basically flat for 2015. Most of the gains were concentrated in a fairly small number of companies, you know, the FANGs, if you will, and a few others. And a lot of the funds were piled under those stocks, and their unit holders, by extension, were piled into them. As I'm sure your listeners all know, those stocks have all had a fairly bad start to the year. I think as a group, they're down about 25%. It makes me wonder how much of an issue fund managers are going to have, or at least assume they're going to have, with redemptions this quarter. If I was a fund manager going into March, who had been piled into those stocks, I'd probably be saying two things to myself. One, I want to get rid of the worst ones so I can be seen as not owning them at the end of the quarter. And two, I've got to assume that when I send out quarterly statements, I'm going to have a bunch of pissed off unit holders that are going to ask for redemption, so I better get my cash out. And I really wonder whether, you know, if the S&P drops like another 50 points, if that doesn't unleash that. And if that's the case, then, you know, we could see our 25% pretty quick.
Yeah, I'm with you there, Eric. I'm going to scroll down the screen a little bit more. Bearish sentiment signals. We've talked about those. Is there any other that we haven't talked about yet, Eric?
I mean, the one thing that I keep an eye on, and it looks, again, I mean, I'm not I'm not trying to be Mr. Bearish, but it looks pretty ugly, and that's the high yield indexes, and I know people that are bullish will say that's all oil, and there's some truth to that. A lot of the high yield bonds, not surprisingly.
Okay, I've got that, Eric. I've got that chart on the screen now. That it's the B of A high.
Yeah.
Okay.
Yeah, and that spread that's a pretty scary spread, and it's gotten worse since that issue went out. If somebody types in HYG on their U.S. screen to look at the high yield ETF, I mean it's just ugly. It just keeps getting worse. And one thing I've noted several times in the last few months is, the bond market, guys that trade bonds day in and day out, they tend to be a bit on the conservative side. They tend to smell risk early. And while I would agree with equity bulls that you do get false negatives sometimes from the bond market guys because they tend to shoot first and ask questions later, they do have a pretty good track record for seeing risk coming before the equity markets do. And these guys are clearly worried about a lot of things because the yield spreads have gotten really wide.
They've only been that high, if I'm reading this right, they've only been that high in this chart in around 2012 and then 2008.
Yeah, it's actually above where it was during the quote unquote Euro crisis in 2012, and it's actually at the high end of where it was in 2008 after Lehman when the crap really hit the fan in the bond markets.
Okay, so that was sort of
literally freaking these guys out.
So actually, I would say, the last time when 2008 period there was a lot of, the world was ending kind of scenario. So, I can understand, I could maybe X out some of that spike, but this spike looks like more of a rolling kind of action that's building up pressure, not just all of a sudden like a start goes parabolic, right?
Yeah, it's not like it doesn't feel like a reaction to one thing. It's the whole index generally getting weaker and weaker. There's clearly a lot of things bothering bond traders right now. They're not a happy group.
Well, Eric, regardless of whether whatever someone wants to call you, you're just bringing up the numbers, and these are the numbers. I'm looking at the chart, and it kind of looks the same to me.
Yeah.
Big spike in concern there, just recently, really, in the last 6 to 8 months, it looks like, or maybe a little further.
Yeah, no, it's really been climbing. It's only really looked significant in about the last 3 or 4 months, and so far it's just going one way. And again, if you're a bull, you can make the argument, and again, there's some truth to it that it's getting to the point where it's almost a contrary indicator where you should see a bounce. But I think we're going to see some bankruptcies before we see the bounce, unfortunately.
All right. Well, let's keep moving through. So, although you're sort of painting a difficult picture, you also say no repeat of 2008, and then I see a Empire Manufacturing and Philly Fed survey. I think they play into each other. So why don't you let us know about that, Eric?
That chart and the one below it, which is it's the Fed's industrial production reading.
I'm actually able to get them both on the screen while you're talking, Eric.
Those both essentially cover the industrial side of the economy. Those that are primarily bullish would argue that that's a shrinking part of the economy anyway, which it sort of is, but nonetheless, in the industrial side has been a good indicator of recessions to come, and the Fed's industrial production reading particularly has a pretty good track record of not sending out false negatives, and it's basically been saying for a couple of months now it's at levels that you usually see immediately prior to or even at the start of a recession.
Now, this particular chart, you only go back to 2011, so I do see that period from about April 2012 when it went underwater there.
Yeah, that one you're a little more prone to. I would call them false negatives because you were getting similar readings during the Euro crisis and stuff. The chart below it, which is the Fed's own.
Well, hold on, Eric. I see one other thing that that when I did see that movement in back in 2012, it was sort of like a choppy stock chart going sideways. What I've
Yeah.
seen in the chart since around October of 14 is that it's been like a stock that's going from top right to bottom left, or sorry, top left to bottom right, on a sort of a consistent pattern there. Is that, do you think that that's different than the last time it was sort of volatile?
Yeah, I mean, I think the last time some of what we were seeing was follow on from the euro crisis. We were seeing some of the budget crisis in the U.S. I mean, and the second of which was certainly a tempest in a teapot. I mean, what we're seeing now seems to be more of a well-defined trend that's been going on for over a year, and you're seeing a similar trend in the Fed's industrial production number, which is a national one. The two above, the Philly, as the names imply, the Empire State and the Philly Fed are both regional indexes. Industrial production is a national one, and that one in particular doesn't have much of a record of false negatives. It tends to
now this other chart you show seems to be a lot more accurate at predicting the recessions.
Yeah, and that's a much longer term chart. Obviously, it goes back to 68.
70.
And that one, you know, the Fed focuses on payrolls, and Wall Street focuses on payrolls, and payroll numbers have been good, no doubt about it. And it was really nice to see a bit more of a wage increase in the last one. It's way overdue. But the thing to keep in mind when you're watching for recessions, and I'll be the first to admit that spotting recessions in advance is almost impossible. Payroll numbers are lagging indicators. So, you know, looking at the monthly payroll report and expecting that to tell you in advance when you're going to see a recession, I'm afraid you're going to be out of luck, because by the time it goes negative, you're already well into it. It's just not an indicator that's any use when it comes to looking for profit recessions or economic recessions.
Man, I'm just looking at that chart, Eric, and I'm looking back at the payroll numbers, and that there hasn't been any wage pressure since '85.
Yeah, it's painful.
Holy
I mean, it really is. I mean, and you know, it was funny the way the market reacted to the last payroll report. I mean, it sold off because people saw an increase in the average hourly wage, and you know, the concern of traders. And again, this is just something else that tells me we're in a bear market, which is the way traders react to things. They chose to react negatively, and it's like, you know, oh my God, people are getting a bit of a raise, so that's going to be pressure on profit margins. like it's bad if anybody outside of Manhattan gets a raise.
I see that you've got the combination of industrial production when that's in a decline and non-farm payrolls. That's the indicator of a recession, when you get a combination. And it's what I'm seeing is the industrial production, if it's a stock chart, is a lot weaker than the payrolls numbers.
Well, that's what you'd expect, because payrolls are lagging. Normally, and keep in mind the payroll number, all of these numbers really, but payroll numbers particularly, you know, everybody focuses on the first number that comes out for the previous month, but these things all get revised 3 or 4 times.
So you're looking more for the industrial production number to lead the payrolls number. I got you.
Like payrolls, normally, if you look back on the chart, you'll notice that the payrolls themselves, they tend not to go
quite as quickly.
They tend not to go negative until you're right into a recession.
Got it.
I mean, I don't think nobody enjoys laying people off, so I don't think most companies don't do it until it's staring them in the face.
So the
production numbers come off first, and then suddenly you're building up inventories, and you're not selling as much stuff as you're making, and you know, generally not long after that,
the job
management decides it's time to start cutting back.
Got it. So I'm going further down. Now you get into the yield curve thing. I've got the chart of effective federal funds rate is up there now for you, Eric.
I wanted to comment on that because this is something that comes up a lot with people that are, you know, primarily bullish right now. It's taken as a, you know, it's basically taken as a truism, as a 100% guaranteed indicator that you're not going to get a recession unless you get an inverted yield curve, which means short-term yields are higher than long-term yields.
My difficulty with that, Eric, before you get onto this, is that, with the Fed controlling so much of the market, managing it, manipulating whatever you want, they are the market now. I'm not as convinced that the yield curve is as good of an indicator as it used to be.
Well, and more to the point, when you've got short-term yields where they are right now, which is at about 25 or 30 basis points. If you look at most of that chart, and that's a fairly long-term chart, it goes back to the 60s. Indeed, when you look right before recessions, you will see quite often this move up in interest rates. And yes, most people outside of the Fed would tell you that recessions were caused by policy mistakes by the Fed raising rates too much. In this case, I don't think it's a useful indicator, because if you look at the right side of the chart from 2010 on, it's flatlining near zero.
Right.
And I think when you're dealing with short-term rates of 20 or 30 basis points, it's going to be a hell of a job to get an inverted yield curve. I mean, basically, that implies anything past about 1 year out is going to be negative. And I don't see that happening.
Going below zero is kind of hard to invert.
Yeah, is it possible? Yeah, but in order for that to happen, we basically be in something that would look like a depression to most of us. So, I don't think the inverted yield curve is going to be much of a signal, because by the time we got into an economy that would give you an inverted yield curve now, things would already have fallen apart. So I don't think it's any use as an indicator right now.
I think the earnings and the valuations and where earnings are going is the indicator now. I don't think you can use the bond market as much as you used to be able to as an indicator of what's going on.
Yeah.
So Eric, we've gone through all of those in the first article. I'm going to pull up the second one. Eric Coffin's predictions part 2, USD, China, and oil. You start that off with the US dollar still tilting at windmill. I like that. What's going on there, Eric?
And to bring it down to its simplest form, when you look at currencies and how they trade against each other, it's important to remember that there's no such thing as a single currency trade. I mean, currency trades by definition are always pair trades. You're buying one and selling another.
Right.
And longer term, what usually defines exchange rates is two things, and that's differences in real interest rates between different countries. The one with the higher real yield should be a stronger currency, and higher real growth rates. Again, the country with the higher real growth rate should have a stronger currency.
Yeah.
And on that basis, it's not hard to understand why everybody on Wall Street expected the dollar to go through the roof, because to their mind, the U.S. was going to have stronger growth rates and stronger interest rates.
Even if we're just better than zero.
Yeah. Yeah, exactly. And I think that's where I parted company with that estimate was, well, for two reasons. One, of course, is that I think we could have a mild recession in the U.S. So I'm not assuming the differential between the U.S. growth rate and, say, Japan or Europe is going to be as large as everybody on Wall Street assumes. I think the U.S. will be stronger, but I don't think the differential is going to be that large. Similarly, I don't really believe the Fed's prediction that they're going to raise rates 4 times or 6 times this year. I mean, based on the first thing, I don't think the second thing is going to happen. And it's also worth keeping in mind that this whole picture is going to get distorted by the fact that both Europe and Japan are in deflationary environments right now. It's something that we're just not used to dealing with, and it makes the math a little bit funny. If you look at say Japan, well, look at Europe, for instance. Their growth rate's probably it's not much. It's probably 0.06 or 0.07 or something right now. But it's a deflationary environment, which is the reverse of what people are used to dealing with when it comes to real growth rates. If you've got a 0.6 growth rate and 1% inflation, 1% deflation, your real growth rate is actually 1.6%.
Right.
That's why, like when you combine these things, I just don't think the differential is going to be as big as everybody thought it would. So I don't see any reason why the US dollar should be that strong.
You're making the case that it isn't it's been an easy parking lot trade for a long time now. Put your money in U.S. market, put it in USD, and you should be safe because we're better than the rest.
Yeah. Well, and that's the other reason why I expected to roll over was the trade was so
Crowded.
incredibly crowded. It was just ridiculous. Everybody and their dog was long the U.S. dollar.
Well, and you can see it in the chart. You know, I'm pointing now. I'm pointing to the period just after December, and it was like nothing could stop that U.S. dollar from, you know, wanting to trade up to it par 100.
Yeah.
But then we had this little action. Finally, it broke here recently. It's now broken under that 50-day. The next big crucial point is the 200-day. When you printed this chart, it was at 96.89. Do you think we got a good shot at testing that and maybe going through that 200-day?
I think we might be there today. Actually, I'd have to pull up today's chart, but I think we might actually hit it today.
Oh, 96.06.
There you go.
So it cracked below that 200. Ooh.
Yeah.
Ooh. Now, the other thing I've talked a lot about is I've been looking for, look at this support it keeps getting here at around the 94-ish type. Tested it 1, 2, 3, 4 times in the last year. That's the crucial one to me. If it breaks below 94, I think it's going back to, you know, around the 80, mid 80 range somewhere. That's an aggressive move.
I hope so for our sake, because if that happens, then we're probably looking at a $1,400 gold price.
Well, that's what I was calling for, 1,350, 1,400 at the beginning of the year. So these charts, maybe they'll be right once in a while, Eric.
Yeah, that'd be a nice change of pace.
Okay, so the next one you've got up is after you invite people to get to that subscriber investment form and register. Launch failures, interest rate changes for selected advanced economy central banks. What's this chart telling you, Eric?
This is an interesting chart, and you know, maybe the Fed will be the first one to break the walls here, but the colored lines on the left side of the chart, those are interest rate increases instituted by a bunch of different central banks since 2009. The gray lines on the right side are what happened after those rate increases. And basically in virtually every case, except the U.S. so far, those central banks have given back those rate increases and gone back to
I see what
zero.
Now I get it. So the colored is the increases, and then post increase, it goes to like a grayish color, and they all go down.
Yeah.
Most of them.
All the central banks that tried raising rates earlier this expansion, they've all thrown in the towel and gone back to it, and in several cases, of course, below zero now. They couldn't make them stick.
New Zealand and Canada are the last.
Yeah, we're the most stubborn.
Yeah. Well, we're commodity producers too. There could be something to that, no?
Yeah, hopefully. I mean, you know, unfortunately, I don't think it says anything good about what's going on in the world that all these central banks have had to roll these back. But you know, it is what it is. That's what's happened. Is the Fed going to be the first one that manages to do 2 or 3 rate increases and make it stick? We'll see.
It's definitely funny times, Eric. I never thought I'd see some of this stuff in my career, but I've got up here now the rate hike chart and the U.S. 2-year bond yield.
Yeah, if you take a look at that yield, that tells you what the bond market thinks about the Fed's trying to basically manage the rates and talk rates higher. After the Fed did their rate increase in December, you saw that 2-year note bounce up about 20 basis points, and then it's turned around and dropped about 60 basis points, and it's now trading well below where it was before they did the rate increase. So it's pretty obvious bond traders don't believe the script for a minute. They clearly don't. They clearly don't think the Fed's going to raise rates anymore.
So now they're finally, looks like they finally lost all credibility.
Pretty much.
That's what that's telling you.
Yeah.
Now they lost it. It looks like they've lost it before, Eric. Going back You know, they were given back to around mid last year, I believe.
Yeah, I mean, bond traders, the bond market, unlike the equity market, has never really been. They've really never believed the whole rate increase scenario. Even if you go back to the middle of last year, where we saw equity markets bouncing up and down based on Bernanke and then Yellen, promising a rate increase for sure. They really meant it this time. You rarely see much of a reaction out of the bond market. The guys that trade bonds just do not believe this whole rate increase scenario. They just think it's a crock.
Yeah, well, it's obvious from that chart there. Now the next chart I'm looking at here is your China. Here's the thing, and you've got the key central bank assets percentage of GDP. What's this one giving us an indicator of, Eric?
I thought that was a very interesting chart that Schroeder's put out. What they've done is they're showing the increases or decreases in the size of the central bank balance sheet compared to the economy that the central bank represents, and what it shows you, and it maybe helps explain some of the deceleration that we're seeing in China, and that's that the transactions that the Bank of China has had to undertake to keep the yuan from falling apart, plus the capital flight they've been dealing with, they've really shrunk their balance sheet enormously, actually, and that shrinkage has been accelerating for the last little while.
Okay.
And that's capital flight as much as anything, but in doing that, they're sucking liquidity out of their financial system,
which is slowing the GDP. Okay, I gotcha.
Yeah, it's kind of working against these. At the same time, they're doing these interest rate cuts and they're doing bank reserve ratio cuts, but that's all being worked against by these transactions that they're doing to try to keep the yuan stable. So they're almost fighting themselves on this, and that's part of the reason why a lot of people in the market think that at some point in the not too distant future, the Bank of China is going to have to bite the bullet and just go for a fairly big one-shot devaluation of the yuan. I don't know if they're going to do it. I don't think they really.
Well, if they want that, they could probably just float it right now and would get the devaluation that they want.
Well, yeah, and they've got they have a big enough. I mean, they still, even with the shrinkage in their foreign reserves, they're still enormous. So, I mean, they've got the foreign reserves to defend a new peg if they want to do that. I don't think they're crazy about the idea of doing it because they worked so hard to get to the point to where they may become a reserve currency over the next few years. That's something
but
the peg really want.
The peg is killing them right now when the USD is strong.
Yeah, I think they've got to. I think it's one of those things where they've got to make a decision. The tricky part doing this if you're a central bank is doing that kind of a devaluation and then getting the market to believe that it's going to be a one-off. That's where it's going to be tricky. Is can they do like a 20 or 30% devaluation, but at the same time convince the currency traders that they're done. That it's not going to keep dropping. They've got lots of foreign reserves. I mean, they can defend the currency. It's a currency I wouldn't want to go short against after devaluation, but there's a lot of people think they should just do it. Just get it over with.
I'd be lining up to buy it at the bottom, Eric, to tell you the truth.
Oh, I think if they did that, there's enough people in the market that don't expect that, and this is part of what's holding them back. I think is that if they did that sort of surprise devaluation, I think you'd see some pretty scary action in the markets following that. I mean, if you want to get your 25 or 30% drop in New York, I think that would probably do it.
Okay.
If traders woke up one morning to see the yuan devalued 30%, I think you'd see them selling everything in sight.
So
it wouldn't be that would be a short-term thing, but I don't think the Bank of China really wants to be accused of being the ones that started the cascade. I don't think they're crazy about that.
What's the BOJ telling you, Eric? Why is that one spiking so much?
It's. I've always found it strange that the yen's a safe haven currency. It's partially because because it's deflationary. Their yields are, again, their real yields are a little bit higher than their nominal yields, but it's also because it's such a big market. Because Japan's been floating bonds at a massive scale for so long. It's a really big, really liquid market. I think that's why a lot of traders like it.
Oh,
And
because
it's one
they
of those
got the
places where
liquidity.
yeah, it's one of those places they seem to like to hide. And you saw that even in the last couple of days when they cut their rates to their reserve rate to minus 10 basis points, and the yen went up 4 or 5 handles in the last 3 days, which sure as hell isn't what Kuroda was planning on when he did that. He's probably sitting there going, what do I have to do to get guys to sell yen these days?
What's the ECB and Fed? They seem to be meandering in the same trend there.
Yeah, I mean, they're both.
Although lately it looks like they might be diverging.
Yeah, I mean, the ECB still they're making no bones about it. They're still growing their balance sheet. They're still doing QE, whereas the Fed's starting to back off. And again, it's tricky for the Fed. I mean, they really want to shrink their balance sheet, but they got to pick the right time to do it. Because if they withdraw liquidity with things as shaky as they are right now, they're probably getting a lot more hesitant about the idea of withdrawing liquidity from the system because there's already, there's been enough scary stuff lately.
Over a quarter point move. I can't believe that, Eric.
Yeah, it's amazing the market reacted. In the greater scheme of things, a quarter of a percent is nothing.
You know what it's like? It's like when I used to go to the racetrack right after the horses run past the wire and the guy loses, he throws his ticket on the ground like he's really mad and stomps out of the racetrack. That's what that trade's looking like to me.
Yeah, no, it's really it tells you how sketchy things are when the market reacts that much to an interest rate change that really is almost meaningless at any real level. I mean, that tells you how shaky things are when the market reacts that much. I mean, nobody should even care about a quarter percent.
Well, it's all the build up and bullshit that went into it, right, Eric? The next chart I got up here is now we're getting on to the exciting stuff. Commodities. Commodity price performance. Ooh, lots of red there.
Yeah. I mean, there's 2 charts on that page.
I've got them both on the screen, actually. Oh, yeah, I can sneak them both on the screen, Eric.
And that's one of them is basically price changes for 2015 for a bunch of different commodities. The other one is a comparison of domestic production, that is Chinese domestic production.
Okay, so here I'll give people a quick rundown. On the low end, minus 10% corn and gold, silver. On the high end, you're looking at Brent oil, nickel, WTI oil. Is that iron ore? Down minus 37%.
Yeah.
So there's a couple things happening here. It looks like we got some precious metals being less punished, and oil and nickel, iron ore. Well, that makes sense, right? Based on your next chart.
Yeah, it seems that there's a correlation. I don't know how strong a correlation is. The 2 charts don't match exactly, but it's a similar list of commodities. But if you notice the commodities where there's the biggest difference between Chinese demand and Chinese domestic production, by and large, those were the commodities that had the biggest runs going into 2008 and from 2010 to 2012. And I think that's a function of because the Chinese couldn't grow internal production to match demand, there was the largest change in external demand, the demand that the rest of the world saw. And I think that's why you really saw the big mining companies, the big mining houses, really pile into some of that stuff, especially things like iron ore and coal, where you saw these huge increases in supply in the last 4 or 5 years.
Oh, yeah, okay. I'm pointing to that now. I got coking coal, and it's had like 70% consumption and 65% global production increase. Whereas you highlight an area where we've got, looks like gold, potash, gold, iron ore, bauxite, copper, nickel, where you've got...
Those are all the ones where someone on the outside looking in was seeing really big percentage increases in demand because China couldn't fill those things internally, so it was going outside to the export market to buy that stuff, and I think that's why most of those commodities in particular, you saw the biggest annual increases in demand, and that's why in turn you saw the big mining houses really jump on that stuff hard. They were building out, potash and iron ore and coal all over the place, which is why those three things in particular are probably in the most trouble right now. They're probably the most oversupplied.
Now, there's the next chart I've got here, Eric. We're getting down into oil now. We'll move on here from. We're into the oil chart. Oh my, that's a bad looking chart.
Yeah, it's not pretty.
Oh, it looks like it hasn't found a bottom yet either.
No, oil is it's probably the most traded commodity there is. So there's a ton of guys on both sides of that market, and I think you're gonna, in percentage terms, I think you're gonna see really high volatility because you've got guys with so much conviction on both sides of it. But if you look at the supply demand numbers, they just don't look good. And the truth of the matter is, I don't think OPEC is going to cave personally. I mean, I think having lived with the pain for this long, I don't see them cutting production. They're going to wait for the frackers and the higher, the oil sands guys, the higher cost production. They're waiting for them to blink first, and I think they will. But now we've got so much oil in above ground inventories. I can't help but think we aren't going to see lower lows before we see price moving up again, because there's just so much of this stuff piling up.
Well, based on the chart, Eric, it just seems to be accelerating the gap between the 30 and the 100-day, I think, or the 200-day. Whenever that happens, that ain't a good sign, man. It means there's still a ways to go, and it's on big volume too.
Yeah, no, there's huge trading in that market. I mean, it's incredible how much movement we're seeing. I mean, today was a good example. I think we had like a top to bottom. It was probably like a 10% swing, and we're seeing days like that. It seems like almost every day now in the oil market. It's incredible.
So Eric, if you were playing oil, I'm looking at smaller names. Are you looking at smaller names or ETFs? What do you think a good way to play if you think it's getting near a bottom? I mean, at some point, what can this go down to? $20? We got to be within 20% of the low, I would hope.
I may get tempted on the ETF at some point. When it comes to specific names, I'm probably going to plug Keith, quite frankly.
Well, I'm going to bug.
When I think it's time to go long, I'm gonna ask Schaefer to give me some stock symbols.
I'm going to invite him on his show.
Oil and gas guy.
I'll invite him on a show too.
Good idea. You should.
Okay, so now there was more. The next chart I was going to. That's the U.S. crude oil production. You've got a chart there of U.S. crude oil production, domestic.
Yeah, and those are weekly data points, and it shows basically the last 12 months up to now, and then the 12 months previous to that, the two different colored lines. And the amazing thing about that chart to me is it hasn't fallen off yet. You still haven't seen the current weekly production drop below where it was a year ago.
Wow.
Which is mind-boggling, really.
So, okay, I got it now. So 2014, you're looking at the 14 and 15 chart, and on top of that is the 15, 16. So it hasn't even broken below.
The same weeks, yeah, in each year.
It hasn't broke below the peak of 14, 15 yet.
Yeah, it's amazing, really. I mean, it really is. I mean, it's really quite amazing.
Eric, how can you do that? They're not only swapping dollars for dollars, they're swapping $1 for 80 cents.
Well, I think they are in a lot of cases. I do know that, and I'm not an oil and gas guy, but I know from talking to some oil and gas people, one thing that struck me was that a lot of them said, keep in mind once you get a well in, your cash cost, if you will, isn't really that high. Mm-hmm. So, you're probably not gonna be drilling many more wells, but in terms of what you've already got out there, you can put up with a lot of pain when it comes to low prices because your actual operating cost is that high. time.
Oh, so let's say if you looked at a well on a per well basis, and I've made $100 or $1 million off of this well, if I lose a bit for a while, it's not that bad because I've already
Well,
spent my
yeah,
capex.
the costs are sunk once you get the big drill to tie in. So your actual operating cost isn't that high. The other thing that may be going on here, and we saw this, if you go back to the late 90s in the mining sector, unfortunately, we're probably seeing it again, where you saw a lot of companies, and this is certainly the case in the oil and gas sector, that built up really huge debt loads to get to the point where it's really the guys that own the debt calling the shots. And it may well be that you've got creditors of these oil companies saying to them, we want you to open the taps as far as you can because all we really care about is you covering our interest.
Oh, that's a scary thing. Eh? Producing just so you can cover interest payments. Yikes. Your next chart is demand supply balance until Q4 16. You there? Oh, I lost Eric. Sorry, folks. I'll get Eric back on the phone here. We must have had some technical difficulties. That's all right. Eric will be back on the phone in a second. Just give us a second, folks. Here we go.
Hi, technical difficulties.
That's okay. We're back on. I got you on the demand supply balance chart until Q4 16. What's that one telling you, Eric?
This is the one that comes out from the International Energy Association. And
so this is global, right? Global?
Yeah, it's global.
Okay.
I think they updated this chart. I haven't seen the chart, but I think they updated their numbers again this morning and made them worse, by the way, not better. And basically what they're saying is their expectation is that OPEC outside of Iran, Iraq will be flat. Iran, Iraq will add about 600,000 barrels a day, and they're expecting something in the order of 1 million barrels a day to come off in places like the U.S. by the end of the year. But because you've seen the bars on that chart are additions or subtractions to above ground inventory, because it's been getting added for so long, even at the end of this year, you're still not really getting to the point where you're removing oil from inventory.
Oh, so that's like a stockpile? The blue is the stockpile?
Basically it's additions or deletions from stockpiles every quarter.
Okay.
And according to them, even at the end of this year, stockpiles still are dropping, which is why the IEA is fairly bearish on the oil price, actually. Their expectation is that it goes lower before it goes higher based on these inventory numbers. They just don't get, those inventory numbers just don't get any better.
And is this why you think that it's too early to call for a bottom in oil, Eric?
Yeah, it's just until we see the actual daily production drop below the daily demand, and if we believe the International Energy Administration, it's not going to happen until the end of the year. It's hard to see a sustained pickup. I mean, that said, there's so many guys trading oil that I would think the minute that we see those two numbers come together, we're gonna see the first bounce, and it could be a really big bounce too. I mean, we could see oil price go up $10 a barrel really fast.
Okay, so you just want to see that supply come off a little.
Yeah, I mean, I want to see those lines come together because, I mean, I don't know. I mean, again, I talk to guys in oil and gas, and they say, the amount of empty tankers that can be filled in, and this and that, and the other thing. There's no real issue yet with above ground storage. But I would be, if I was an oil and gas guy, I'd certainly be nervous about that. If you get to the point where places like Cushing run out of storage, I mean, if that happens, the day that happens, things could get really ugly fast because you've got guys that are going to just sell at any price.
Sooner or later, sooner or later, there comes to a physical peak, sort of how much you can.
Oh yeah, I mean, I'm not long-term bearish on oil. I think we see a bottom. I mean, I think we'll see a bottom this year.
I was going to say that because look at your chart, from 84. Look at the demand line, unrelenting growth.
Yeah.
So.
And that's the one other question mark is obviously what the world economy does in the next weaker than you guys assume. That might be slower, but still, I mean, oil demand's really only gone one way for decades. So
Even
I don't think
after,
we're in any danger of oil prices going to $20 and staying there. I mean, they're going to bounce at some point.
Eric, this doesn't go back to the, well, I guess it does actually. It goes back to Q1 of '09. So that's when the global recession was happening. And after that, the demand just keeps going up and up every year.
Oh yeah, no, I don't think, I'm definitely not long-term bearish on oil. I think we get a bottom put in sometime this year. I don't know whether it's going to be early or late.
So Eric, we
I'd
just
be very
worked.
surprised if it took longer than that.
We worked our way through your slides there on your two articles. You got another one coming out soon, don't you? And
Yeah, most of the actual individual metals will be in this third one, which I'll get up on the site tonight or tomorrow.
okay, well, I don't want you to telegraph it too much, but let's see what we got here. I'm going to go to see if I can find any questions. There was a question. Tommy wanted me to ask you about LIX, LIX. Are you following the lithium play? Does that surprise you?
Why would Tommy ask me about LIX? The mind boggles. I'm not following, and I still haven't. A couple of the guys on the site, like Peter Epstein, were nice enough to send me vast numbers of links on lithium that I still have to sit down and work my way through. I'm not following any lithium deals just yet. I mean, lithium is something that's obviously lithium itself has been quite strong price wise, and it may continue to be. I mean, the demand.
Yeah, but Eric, every time I've ever seen a spike in a low volume commodity, it always results in a supply increase and some rationale that's not sustainable. The move.
Well, I tend to be leery about small market stuff. I don't generally follow it that much. We never really jumped on the rare earth bandwagon, and the reason why we didn't, frankly, is because rare earths aren't that rare, and lithium isn't that rare either, actually.
Well, the rareness, I think,
quite a bit of it around.
I think where people get lost is the rareness relative to the market. It may be rare relative to other commodities in the Earth's crust, but the reality is that you've got so much of a market out there, and you're fully supplied. It doesn't matter how rare it is.
Yeah, I mean, if you're going to get a bottleneck that's going to give you high prices for 2 or 3 years, the best way to play that, I would think, is going to be somebody that can actually deliver product into that market, rather than somebody that's hoping to deliver product 5 years from now.
Well,
may have come and gone.
I'm sort of generally kind of not really jumping on the bandwagon yet, but I got to tell you, Eric, I am compelled by that story of the people involved with LIX and the future story of possibilities of building assets and building a big company.
Well, I think what they're trying to do, and it makes sense. They're trying to get enough attention and make their stock a valuable enough commodity that they can use that to basically go on an acquisition spree and pick up a lot of projects and be a consolidator. And that model may well work given the strength of the management group.
Do you think they
are able to get market attention that other guys can't?
Do you think they got the possibility of getting their own project that everyone sort of goes, wow, that's something special?
I mean, that's, again, I've got to spend some time getting my head around lithium production, because you're talking about brine production there. There are companies in places like Israel that have been working on systems to remove lithium from brine. The question is, can that be done at a commercial scale? I don't think they can do what the guys next door do. Albemarle, which is, I believe, the sole lithium producer in the continental U.S.
And now they just did a deal with the Chilean government, and they've got
with SQM,
yeah.
Well, and I don't think they can recreate literally what Albemarle did, because I I think they'd have trouble permitting, and I don't know where they put them, frankly, the evaporation ponds. There may be more room in places like Chile. I mean, you've got SQM that controls a lot of the office there. But it's not unheard of for those guys to do deals. And there's certainly good lithium brine there. But I really need to educate myself on the economics of the brine versus the hard rock lithium.
You and me both, Eric.
The market's completely different. So.
You and me both, Eric. When you're a faster learner than me. Pass me on some of your wisdom when you get there.
Okay.
I got one more question, Eric, before we close, and it's kind of a two-parter because the question came from somebody wanting to know about precipitate gold on the chat site, but I've also recently been doing a lot of homework on your GQC. So that's why I say they're kind of a two-parter. I think we can go into them together. I had been sort of noticing that GQC since you first mentioned them in the chat site, and then I had watched this joint venture recently at the Roundup. I went and spent some time. You were at the booth as well, and I spent some time with, I believe his name is Jeremy. Yeah, and I was really impressed. He's a young guy, but I really got a good impression that he's, passionate about searching for gold, and he's really on top of what they're doing there. And he gave me a really good understanding of the company. So, I'm getting more knowledgeable about the GQC story as well. So maybe those two you could answer together.
Yeah, because they're kind of joined. Precipitate's main project is essentially next to Gold Quest. They're both exploring what's called the Terreo Gold Belt. Well, what I call the Terreo Gold Belt anyway, which is on the eastern side of the western side rather, Dominican Republic. It's a newly evolving gold belt, and that gold belt is in fact a Gold Quest discovery. Alistair Waddell, who's a friend of mine and who used to be the president of Gold Quest, he originally went into that area because I won't bore you with all the geology, but it was the right age rocks, the right type of rocks. And as it turned out, he was right. There was gold there. Gold Quest has made a couple of discoveries on their property. The most important one by far is Romero, which is the 3 million ounces equivalent. They've gotten to PEA on that, and they're working on a pre-feas now, which should be out. I think the pre-feas will be out next quarter, and they expect to have a full feasibility up before the end of the year. I like that project a lot. I think the grades are good. It's kind of like a blob, so it's something they can mine underground using both tonnage methods. So far, the metrics look quite good on it. And a lot of my comfort with that stock comes from having known the chairman and the president for a long time. Bill Fisher, the chairman, and Julio Escolar, who's a Dominican geologist, the CEO. They took another company by the name of Globestar from discovery through development to production.
Eric, that's the big angle that really, in the past, when I've looked outside of, let's say, Canada, United States, I've always been, know that you have to have a local there that's your champion. And so when I started hearing that part of the story about your locals, it gave me a tremendous amount of less concern about the permitting issues, because these guys have been through. Didn't you tell me that one of them was involved in the writing of the rules and permitting process?
I wouldn't be surprised if Julio had a hand in it, but they're also, he knows, he's dealt with this. He took this other mine called Cerro Mamon, which has been taken over by an Australian company, Perilia. He took that through permitting. Permitting, we all know permitting anywhere is tough. It's always an uphill battle. But he knows, he knows who he has to deal with, who he has to talk to. He knows how to lay things out in a way that's going to basically be favorable with the locals. So, he knows what he has to do, and that's, I think Julio's mainly he's focused on the feasibility, but he's mainly focused on making sure that the local community and the regional communities are all on side with this, and I've seen them do it before, so I'm pretty comfortable they'll get it through. Like whenever you're dealing with a junior, and a junior starts talking about taking something through to production, there's a lot of skepticism, and rightly so. There should be. The skill set that you need to find stuff is quite a bit different from the skill set you need to get into production.
So you think these guys
but
can
this
do
is a
it?
case where these guys have actually done it. Like I know Bill and Julio can do it because I watched them do it before. Our HRA followed Lodestar back in the day until it was taken over, and I know these guys can get it across the finish line because I've seen them do it already.
And what's it? And it right now has like what, a 10 million valuation or something like that?
It's a little more than that, I hope. Well, no, maybe not actually. Yeah, it is. It is probably it's about 25 now, I guess. Give or take.
25, and they're an advanced stage company. They got a PFS that they're doing, a pre-feasibility that they're doing, and what really excites me is they've got a lot of sex appeal on the exploration side.
Yeah, this belt is the thing to understand about the Terreo belt is, it is in effect their discovery. It never saw any exploration before these guys came along. It never saw any drilling before they came along. To me, it's very equivalent to what you'd see in more advanced gold camps, except most of the work hasn't been done yet. There's still, in my opinion, there's a ton of upside for more discoveries. I know Goldquest has had a couple of crews mapping for the last 4 or 5 months. They're working their way south towards the precipitate discovery, and the two companies are collaborating now. They're putting together their airborne database and their geochem database.
So that's going to save them a bunch of money, eh? Oh, that was the other question that the person had about precipitate.
Yeah.
He was asking if they've done enough groundwork to prepare the targets for drilling.
They have a discovery at Ginger Ridge. That one's already a first pass drill discovery. But I think before they do another phase of drilling, they're going to spend some time on these new trends. Ones that they've uncovered and ones that Goldquest has helped them uncover by putting these databases together. I think you'll start seeing news on that very soon. The last time I talked to Mike Moore, the VP Exploration, he's got one of their local Dominican guys running around right now. You've got to run around and talk to the locals. You don't want to surprise anybody. Make sure everybody knows you're going into the field and everybody's okay with it. Get everybody to sign off. So I think once that's done, they'll be scheduling the next phase of work, which I'm hoping starts before the month is up. And that phase of work, they'll probably just go out, prospect map, take some samples, whatever looks good, they'll go back again, probably do some trenching, maybe some geochem, and especially IP. IP has worked really well as a targeting tool for both them and for Goldquest. And once that's done, you'll see the next drill phase. So I'm thinking it's probably
Eric,
2 or 3 months to do that stuff.
When you say that they're working together, how does that work?
They're doing things independently, but they're sharing data and ideas between each other because the whole model for this area is still kind of up in the air.
Oh, so they're just saving.
Both of them have their ideas. Well, the other thing too is that there's sort of I think there's a handshake agreement between the two of them. Like Goldquest, for instance, flew a very large airborne. They gave all that data to precipitate dumped their own much smaller airborne data into it, and they're kind of meshing these two things.
Oh, so it's a information sharing relationship.
Yeah, it's not a joint venture in that sense, although both sides, there's kind of a handshake deal between I think both companies, where if either one of those companies has guys in the field and they think they're onto something and they hit the property boundary, I think both companies have agreed that they can just kind of keep going, and we'll figure out who should pay for what later.
Oh, okay. So it's going to save them a fair bit of money.
Yeah, it should be more efficient for both sides because it's fairly steep area. So getting your guys out there on the other side of nowhere, if you're at the property boundary and you think the trend that you're on continues, you might as well just keep going, and the two companies will work out who pays for what later.
Okay. Good, Eric. Well, are you following both of those companies, PRG and GQC?
Yeah, PRG, Gold Quest I followed for years, and it's had 2 or 3 good runs on discoveries, and I still like it a lot. I think it's quite undervalued. PRG I follow, but full disclosure, I do not rate PRG in the newsletter because my late brother and I were founders of the company, and although I don't have anything to do directly with management, I'm one of the bigger shareholders. So
of PRG.
I can't use the B word in the newsletter.
On PRG.
Yeah.
Okay. Okay. Good. Well, Eric, there's obviously we spent a lot of time here. Thanks a lot for your generosity. Again, I think that I think my viewers and those that watch this show would do very well to go and subscribe to Eric's work. He does good, thorough work, as you can tell from our conversation here. Eric, did we miss anything that we should have talked about today?
I don't think so, but we can always catch up again, Al.
Good. Well, I do want you to come back, Eric. I got a couple ideas about how I'm going to get a studio downtown, so it might be easier for you just to come in and we can talk face to face.
Okay.
You think the room can handle our 2 big heads?
Yeah, well, you got better hair than me, so I'll sit on the side.
Sounds good, Eric. Well, thanks again for coming on, and just hold on the phone, Eric. I'm going to wrap things up here. Again, my reports and the work I do are for information purposes only. It's important for you to speak with your financial advisors and do your homework before making any investment decisions. Eric has covered a lot of stuff here. Definitely go check out his website. Again, I highly recommend you check out subscribing. We're going to come into a stronger market, I believe, for the kind of companies that Eric follows. He does a great job of filtering through a lot of companies. He does a lot of work for you, and that alone will save you money just to subscribe. So go subscribe to Eric's website and or to his service. And on that note, you have a great day, and we will talk to you soon.